Good morning, everyone. Thank you for joining us for our latest Tax Flash webinar by Andersen UAE. We are a global leading tax and legal consulting firm. I'm Pratim. I'm a director with the Director International Tax Practice. I have with me Sahil, who is a director with the Transfer Pricing
Hello,
Services.
everyone.
Today, we don't have just one topic for you. We have actually two topics. One of them is an implementation insights or insights into implementation challenges, mainly from a transfer pricing perspective. And this we broadly caught, from our active engagements and our discussions with, our clients and other groups. We hope to add a lot of value in our conversations today on this aspect. And the second topic is pillar two, where we will be providing an overview and also an update from what countries are doing, where Middle East countries are from a pillar two perspective. We also have polls that are already active in the comment sections. Do participate in that. It'll add a lot of insight to our conversations as we move ahead. With this, I'll ask Sahil to provide a small introduction and take this discussion forward.
Good morning, everyone. Thank you, Pratim, for the introduction. So the whole idea of today's webinar is to walk you through some of the implementation challenges we have faced on our current engagements. As we can see on the slide that we have, on January 2024, the UAE law has been in effect, which means all the taxpayers in the region have to comply with both this corporate tax as well as the subsuing transfer pricing law and ensuring that your transactions are at arm's length. The way this journey has started is in the first 6 months, we have the taxpayers who are trying to understand how transfer pricing or how corporate tax impacts their current business, their existing contractual agreements with the authorities or even with their own related parties. And where we are right now is in the September to December phase, where we are trying to implement all the impact assessment findings that we had. What are the implementation challenges? What are the kind of documents you're supposed to maintain? What are the kind of arm's length relationships you're supposed to maintain are right now being put into place. But having said that, for taxpayers who have not yet started this impact assessment, this is the time to do it. And honestly, based on our experience, I think we have a lot of ammunition in our kitty to help you through all the challenges that we have faced, and to ensure that by December 24, when you close your books, you're already aware of all the adjustments, all the positions that you have to take, all the tax elections that you need to take care of are in your kitty already. So moving forward, I think we're going to move on to the next slide, which talks about the implementation challenges. Where are the key areas where taxpayers have had issues or needed clarifications? Some of them have been provided by the FTA during the course of time. And moving forward, I think the first and most important thing is identification of the related parties. On paper, it sounds simple because there are three categories, which is kinship, shareholding, and effective control, or connected persons. But when we dig deeper into this, we find that taxpayers are having an issue or facing challenges as to whether a party is a related party or not. So let's just give you a quick brief on what these rules are. So the kinship basically is two natural persons who are connected through a relationship, and it goes on to the fourth degree of kinship, which means it includes your parents and your children and your spouse's parents and children, and goes up to the great grandfathers and goes down till the great grandchildren. So any relationship with either these parties or with their businesses are considered to be related party transactions. Second is the most simpler one, which is shareholding, which means the thin line given by the FTA regulations is if you hold more than 50% of shareholding, you are considered a related party. But to keep a note is that it also includes indirect relationship, which means if company A has 100% of company B, who has 50% of company C, then company A and C are also related as part of the indirect relationship. Finally, we move into the most important and the most crucial category, which is effective control and what it means. So say effective control by definition would be that you are able to exert a significant influence, which could either be through a contractual obligation, it could either be through some examples which the FTA has given, such as you have 30% shareholding, but you are able to control more than 50% of the board, or you are able to get 50% of the profit share of a business, or maybe through business or funding issues, which is that you have provided more than 80% of the loan of the other party, then you become by default an effective control related party. And finally, we have connected persons, which would be the directors or officers of the company who hold significant influence or hold the shares in those companies as well, either directly or indirectly. Moving forward, I think once we have defined or overcome these challenges of identifying related parties, we need to ensure that the transactions are also at arm's length. And the key three transactions that we have faced issues overall are intercompany financing, remuneration of your key managerial persons, and intra-group services.
Yeah.
So if we start with intercompany financing, the first and foremost thing that the taxpayers have to identify is how do you characterize this intercompany financing? Is it a debt financing or an equity financing? The way to do that is by looking into the contractual terms of the loan, which are like, what are the repayment clauses? What is the seniority of the loan? Does the borrower have the ability or the cash flows to make those payments? And based on this, we can characterize our loan either debt or equity. So for example, Prateem, or the taxpayer, for example, if you have a loan on which you don't have a repayment schedule,
Yeah.
or the borrower, or it's upon the borrower that when they choose to repay, or also like if the borrower doesn't have the ability to pay the loans as per the common guidelines, those kind of loans are considered equity because no other external funding or financial institution are going to forward you that loan. Therefore, these loans are equity financing and should be accounted for accordingly. So in the terms of borrower, it should come as a capital or a shareholder loan, as well as in terms of the lender, it should be an investment in the associate or the subsidiary. So,
And I think, Sahil, is it okay if I interject?
yeah, sure.
Yeah, so I think what you mentioned about intercompany loans is very important because, when in this region you see that there are a lot of shareholder loans that appear in the balance sheet under equity, and one question that we get from everyone is that will I have to pay an interest on this or not? And that's quite a common question, I think. And when you say that it's an equity item, and when you say that you don't have to pay an interest, I think you touched upon something very important, that it's not just that you leave it there. I think you have to prove that with documentation that ultimately this is something that is equity in nature, something on which you don't need an interest on, and the documentation needs to speak for itself.
Exactly.
Right?
So you have to have intercompany loan agreements which sort of clearly mention that what are the repayment clauses, what is the seniority of those loans, as well as mention the purpose for which that loan has been forwarded to your related party. And this is irrespective of whether it's an equity loan or debt loan. So even if it's a regular loan or a regular financing that you have done for your related party, you need to have these terms and conditions in a proper intercompany loan agreement. And which takes us to the next point, is like, how do we ensure that these are at arm's length? So for a regular debt, your interest rate has to be calculated based on the credit worthiness of the lender or the borrower, which means that you have to have a credit rating based on those credit rating and other terms and conditions of the loan. We do external searches to identify whether your interest falls in the market range or not. Moving forward, one more thing in financial transaction that we have sort of noticed during our engagements is corporate guarantees. So it often happens that just because you are a part of the group, you might get I would say a favorable interest rate, or maybe be even eligible for a loan, and that is not because you've explicitly provided a guarantee, but it's just because you happen to be a part of the group. However, in cases where you have a situation where your parent company has provided an explicit guarantee to the loans, then it's important that we actually charge an interest or a guarantee fee on those loans. Third is the KMP remuneration. So this is an interesting one, and quite frankly, it's an issue in the way the UAE jurisdiction, and primarily because we still have corporate income tax, but we don't have personal income tax, which means is there is a kind of tax arbitrage or manipulation risk from the tax authorities' perspective, that taxpayers might want to make those payments to their KMPs because in their hands it would be non-taxed. Therefore, it's important that any salaries or any director loans or etc. that you have with your KMPs is at arm's length. The way in general that we are doing with our clients or in our engagements is two approaches. So if you are either following an entity approach, wherein because your entity, as part of its characterization of say a low risk distributor, and we are testing their margins at a net level or their operating margins at a net level, and those margins are considered to be within an arm's length range, it could be said that the KMP remunerations are also arm's length in effect. But where such situations are not present, it's very important that we actually benchmark those payments either through industry HR reports or through some other mechanisms which might be specific on a case-to-case basis.
Yeah.
And finally, the holy grail, I would say, of transfer pricing would be the provision of intra-group services.
Yeah.
It's one of the most litigated issues across the globe, and the primary reason is because taxpayers often fail to either identify those intra-group services and accurately analyze them, or they fail to, I would say, allocate them accurately to their related parties. So the way it's supposed to be done is, the first step is that you are identifying those services, properly delineating them so that you can analyze and determine the arm's length on a case-by-case basis. And most importantly, you have to ensure that your transactions are meeting the benefit test. What does the benefit test mean? That the service recipient has an economic benefit received from those services, and at the same time, the service recipient is also willing to pay for those services had you not provided them, which could be to an external party, or it could be that they develop the capability in-house. Once you meet these criteria, then there are some other factors as well, which we can, which not going to discuss in this scenario. But these are the main challenges of how do I determine that I have received a benefit. It has to be documented through functional analysis, through a description of the services, through reviewing the contractual service agreements between the group entities. And once the benefit has been received, we move on to the point of how do we create the tax base, or how do we create the cost pooling. Which are the kind of costs that can be included, which are the costs can be excluded. For example, we do not include duplicative services. We do not compute shareholder activities, that is some function provided as internal audit, some function provided as formulating of your group statutory accounting obligations. So all of these costs are something that we do not include. So once we have this, we move on to the allocation keys. How do we allocate the cost pool that we have to all the entities? The way we do it is that these allocation keys must be commensurate to the benefit received by your service entities. Therefore, what does that mean? Say you have group IT services. Now, how do you allocate these IT services? If you're allocating on the basis of revenue, there's a high chance that you might skew your allocation, because one entity, which could be a sales entity, does not use your information technology systems, but having a higher revenue would get an undue share of those costs. So it's very important that we identify the allocation keys appropriately. And finally, we have the arm's length markup. So an arm's length markup would be dependent on the kind of service you have provided. Are those pass-through costs, which is just like costs you have incurred on behalf of your entity? So that means you have not added any value to those services and should be remunerated at cost. Or if you have certain services which are low value added services, which are like supportive in nature but not core to your business, nor do they result in any intangible creation or etc. Those can be allocated at a cost plus 5% as per the safe harbor that the FTA law has given. And finally, you have high value added services which are important to your business, which are core services, and those services need to be include a markup which has to be determined by an appropriate benchmark study.
Yeah.
Finally, once we have overcome these challenges, and because we are in the last final quarter of 2024, it's important that we look into the next steps. And those next steps start from ensuring that you have identified all your related parties accurately, and that you have subsequently performed an RPT accurate related party transaction mapping. Once you have those transactions mapped, we identify what is the transfer pricing policy for the group, which includes comparability analysis, functional analysis, risk analysis, as well as the accurate benchmark studies to support those TP policies. And finally, one thing to note, Pratim, and the taxpayers, is that these benchmarks are supposed to be maintained at the minimum requirement for 3 years. and they have to be applicable. They have to be financial update every year. So 3 years for a full update and annual financial updates each year for those benchmarks. And finally, you have the taxpayers need to have a TP documentation strategy.
Yeah.
As per the CT law, you are required to mandatorily perform a disclosure form, which has to be go along with your corporate tax return, which is going to be due on September 25. And you need to prepare master file, local file. The minimum requirements or applicable requirements for these are that either you are a part of the M&E group who has 3.15 billion dirhams in revenue, or the local entity has 200 million in revenue. If you meet either of the conditions, you're supposed to maintain a local file. One exception is applicable for master file, that if you are a UAE headquartered group who does not have any subsidiaries outside of UAE or business outside of UAE, then you do not need to maintain a master file, even if you meet the thresholds, but the local file is essential. And then if you are a group who has 3.15 billion or 750 million euros in revenue, then you're also required to meet with the country by country regulations. So these are just the quick updates, something that taxpayers at this point must be aware of. And I'm going to let Pratim take the next questions.
Yeah, I think, thank you, Sahil, for this. I think the important part, I think what needs to be driven home is, one, I think, while everyone is kind of aware that you need to do transfer pricing, some people would have had policies drafted already. By policies, I mean, done their benchmarking, know what percentages, whether it's cost plus, whatever, whether it's TNMM, depending on, where you are. But what do you do with the policy? We've seen that a lot of in-house finance teams, just have this as a document, but tomorrow, how to implement it? Like we can help, there are lots of groups that we are helping that today, like Sahil mentioned, the cost base. What are the costs that you're supposed to take and add a markup on? Yeah. Like have your intercompany agreements in place. Then look at whether you're falling under those margins that have been benchmarked or not. Have those checks and balances. All these things need to be done by December end. And there's not much time. We're already sitting past mid, September. We're about to hit October. So there's a lot of implementation work that is yet to be done from a transfer pricing perspective. And that is just one aspect. So this is very critical for businesses to take.
Exactly. And we are working very closely with all the businesses, working with their tax function, their finance functions to ensure that they understand how these policies can actually be implemented in their ERP systems, how can they keep track of what they are doing, and whether they are actually adhering to the arm's length benchmarking ranges that they have been mentioned. And one issue, the way you mentioned, is that some groups have a global group TP policy, but it's really important to see whether those TP policies are also applicable for the UAE market, because this is a very specific region. The tax law is new, and your benchmarks, although globally accepted, might not really work in this region. So it's ensure that you do that health check before relying on those benchmarks.
Yeah. So with this, I'll give everyone, an update on the next topic, that is Pillar 2. A quick overview. It's good to talk about Pillar 2. It's a buzzword right now, but I want to give, for the uninitiated, what is Pillar 2, right? And let's just touch upon some basic concepts and some terminology before I'm given update, what countries are doing. So Pillar 2 is basically an initiative started by the Inclusive Framework. Now, what is Inclusive Framework? There are, I think 135, 140 plus countries that have got together through the initiatives of OECD and G20. And, they decided that they need to take certain measures to ensure that there is, at least an equality in tax systems across the world. One way of doing it, so they came out with certain measures in 2013 to 15. There were BEPS initiatives. One of the other measures that came out are two pillars. Pillar 1, Pillar 2. Pillar 1 is more transfer pricing focused, and it applies to very, very large organizations, that have revenues of I think 20 billion euros. I think that's the threshold. Pillar 2 is a global minimum tax. By that I mean it's an initiative driven where every multinational that breaches a certain revenue threshold, which is 750 million euros, that's roughly 3.15 billion dirhams. It's not much if you compare it to Pillar 1 thresholds. it's significantly less. And what they say is that if your global ETR, is below 15%, so if it's 10%, broadly speaking, you will have to pay a differential tax going forward of 5%. That's 15% minus 10%. So there's a minimum tax of 15%. But how will all this work? Like, will there be one law? Will there be multiple laws? So, a lot of people, and we've seen that, the general public is unaware of this. It works through a separate legislation. So every country that has signed up or committed to Pillar 2 would legislate domestically these rules. So these rules are broadly called, global anti-base erosion rules, or GLOBE or GLOBE rules, as we call it in the tax world. And, so every country would legislate this, and every country is broadly at different stages right now. So countries have committed to it, yet not passed the legislation like a lot of Middle East countries or GCC countries. But Europe is a bit step ahead. A lot of European countries have already legislated these Pillar 2 or GLOBE rules, as we say. And most of the countries, it's already active from 1st January 2024, will present this. What are these rules? How will it work? So broadly, what this rule says is that if you are a multinational enterprise that has a revenue of 3.15 billion dirhams or more, your ultimate parent. So first thing that you will be seen, what will be seen is where your ultimate parent entity lies. Where is it located? And the first taxing right, so the differential tax that I spoke about, 15% less 10%, the first taxing rights for the entire group would be with where the ultimate parent entity is located. So what we call this in the tax world is a top to bottom approach. So you look at the topmost entity. If your ultimate parent entity does not have these rules, or the country there does not have these rules legislated, you go to the next parent entity and see where these rules are legislated. There are two sub rules called qualified income inclusion rule and a UTPR, which is under tax payments rule. I will not get into the finer points of it. It is quite technical, and we might cover this in another webinar for us, but broadly it works on those concepts. Now, when I say that you look at the ultimate parent entity and where it's located, where does that leave, other countries? So there's a multinational present in 10 countries. So the differential tax is, kind of taken by the ultimate parent entity's country. What about where the subsidiaries are located? Those countries don't get anything. That is where this terminology or this concept of qualified domestic minimum top-up tax comes in. So what does that say? That says that if, say, UAE, like you are a part of a multinational company and you have a UAE subsidiary, UAE, if they legislate a domestic top-up tax, that means instead of the ultimate parent entity paying it, the domestic top-up tax will take precedence. So UAE will then get a legislative right to collect the differential tax for the UAE subsidiary. So you will suddenly, the taxing rights will go away from the UPE and will go to the UAE subsidiary, and you will have to look at each country. This is where it gets complex, because every country now will start legislating domestic top-up tax in order to ensure that it collects its fair share of revenue.
Yeah, I think Bahrain has taken
Exactly.
the first step towards it. Yeah.
Exactly. And every country would be doing this, and this is where it gets complex, and you need to see where every subsidiary is located and how much top-up tax is to be paid jurisdiction by jurisdiction. There are some exclusions to these rules. We call them substance-based inclusion. So when I say 15%, you have to apply that on certain income. The GLOBE rules have a completely different methodology to how do you calculate this GLOBE income on which you apply 15%. There are very detailed rules related to that. But I would say, from a professional that's gone through these rules in detail, some of those exclusions, some of those adjustments are very similar to what UAE corporate tax has legislated, very honestly. So the kind of changes you have to do is far less. There are some exclusions. If you have payrolls, if you have heavy payroll costs, if you have tangible assets, you get a certain percentage of them. of those asset or those costs that reduce from your income. Even if you're in a different jurisdiction, you have certain exclusion. That jurisdiction you don't have, pillar 2 will not apply if you have a revenue of less than 10 million or a globe income of less than 1 million for a consecutive 3-year period. So there are exclusions there. You'll have to look at it. Moving on, what are the updates? What are countries doing? Some of the key jurisdictions that have adopted this globe rules and this qualified domestic minimum top-up tax. You can see majority of the countries that are listed are European countries, and for these countries the pillar 2 applies from 2024. Where the complications could arise is if you're a UAE headquartered country or a company and you have subsidiaries in those countries. UAE has not adopted pillar 2 yet, but those countries have adopted it. So you could have a complicated situation where pillar 2 applies to one of your subsidiaries. From a Middle East perspective, like Sahil has mentioned, Bahrain has recently legislated the domestic top-up tax, which is effective from 1st January 2025. Qatar domestic top-up tax is expected. UAE has actually made changes to its corporate tax law, included certain definitions on what is a top-up tax, what will be a multinational enterprises, and legislated these things in the corporate tax law. UAE's also come out with a detailed consultation paper, and very interestingly, in this consultation paper, it has been indicated that free zone companies would be covered by pillar 2. So whenever pillar 2 arrives, even though you might be a free zone company benefiting from 0% corporate tax, if pillar 2 comes in, you might be taxed at 15%. So you will have to look at this interplay and plan for it. And also the UAE is given a hint that if it applies pillar 2, if it legislates pillar 2, it'll come out with other tax incentives. So some income-based incentives or some some investment-related incentives. So this is a space that needs to be, people need to watch out for. What are the next steps? If you think you're applicable, do an applicability study. If it's applicable to you, you need to also plan as to what outflow you will have from a tax perspective. You will also need to carry out system changes to account for this reporting. You need to do separate reporting from pillar 2, which is a separate kind of return from a corporate tax return, and you need to be ready for these compliances. So I know UAE corporate tax law, everyone's just gearing up to it, but pillar 2 is on the horizon, and I think everyone needs to be ready for it.
And I think it ties down really well with if you have done the transfer pricing and the CT impact assessment already, with an idea of like having a forward-looking approach. That is what we are advising our clients, is that if taxpayers implement this forward-looking approach in maintaining their systems now, it will make the life of everyone quite simpler moving forward, and once this pillar 2 actually gets implemented in the region.
Yeah, I think so. But there is a lot of work, and I think people really need to study. So there are two kinds of entities that this could impact. One is UAE headquartered entities that are present not only in UAE, but outside UAE as well. They would be considered to be a multinational enterprise. So if you breach the revenue threshold, pillar 2 will apply. Or you're a subsidiary of a foreign multinational enterprise and you're in the UAE. So the two kinds of entities that this could apply. Like I mentioned, the complications will come in if you're a UAE headquartered entity and you have a subsidiary in a country that has already adopted pillar 2. So this is where the complications could arise. With this, we are, thank you. We are, done with the presentation.
We're open for questions.
We are open for questions. What we will do is look if anyone has given a question or not and see if we can answer it. We have, I think, about 3 to 4 minutes available with us. One question is, UAE corporate tax directed to taxpayer to meet arm's length principle for their outstanding balances with related party. Could you suggest the implications that taxpayer may face if they're unable to meet arm's length principle on their outstanding balances?
I mean, one of the key risks would be that there would be a tax adjustment which happens, and accordingly, if a tax adjustment takes place, which means you will have penalties and interest on the outstanding tax adjustment that the tax authorities will make. But that's from the transfer pricing perspective. Yeah.
Another question we have is, after Pillar 2, does this mean the free zones will not get 0% anymore for MNEs falling under the threshold of 750 million euros? For now, yes, that's the understanding, that free zone entities will be covered by any kind of, at least the MOF has indicated that free zone entities would be covered under the legislation. If there is any exception provided, we need to wait and watch what is finally legislated, but that is the current understanding for now. One more question that we have, very interesting. How is shareholders' additional contribution treated under transfer pricing? I'm guessing this additional contribution
It's
means a capital contribution.
Yeah. So it shows as an equity on the borrowers on the recipient side, and it shows as an investment or a capital contribution from the person who is making that contribution. So yeah, I mean, from a transfer pricing perspective, there's nothing to. It does not hit your P&L as such, so there is really not a arm's length consideration that has to be taken into account, but it needs to be ensured that these transactions are accounted for properly in both the books.
One more question that we have, does it mean that for financial statement purposes, the transaction should be reclassified as either debt or equity based on TP rules?
Yes.
Okay.
That is one of the most important, that it has to be the characterization of your financing is really important. So if it is equity, because we have seen some cases with some of the engagements is you have in one of the books, the amount of financing is being shown as under the shareholder or the equity contribution as a shareholder loan, whereas in the other books, it's not showing as such and it's showing as a regular loan, which is incorrect. So it has to be shown as an investment in subsidiaries or associates or a related party, and accordingly on the other side, it has to be shown under the shareholders or the equity contribution.
So there is a clarification from the previous question as to additional contribution, and they've mentioned that it is not classified as equity. I think this could be a area where an interest could be warranted, right?
Again, it depends on the characterization of it. So if the capital contribution is as such made because the entity is not able to receive any other funding from a financial institution, and also either does not have the cash flow to support that, it becomes a capital contribution. So there is not particularly a reason to charge an interest on it, but that's the position that we take on a case-to-case basis, and depending on what the economic circumstances are for that contribution.
Understood. I think, again, I keep telling this to a lot of people. Transfer pricing is the first tax avoidance rules ever legislated in the world. So transfer pricing is to do with substance over form. Like Sahil mentioned that whatever you do from an accounting, I know that UAE corporate tax law, the computation starts from your accounting income, but transfer pricing looks beyond your accounting entries and actually looks at what you're conducting. Even for intra-group services, like Sahil was mentioning, that benefit test is very important. We have, we come from jurisdictions where we had, why is it litigated? Because you have so many instances across the world that there is a cross charge between two related parties across the world, from one country to another country, but no service is actually provided. That will eventually catch up to you.
Exactly. There has to be an economical and a commercial rationale behind any transaction that you're having between your related parties. So that trumps everything else. Like taxation flows subsequent to your form or your substance.
I think the poll questions, I think we're still waiting for more answers. Majority have said that they have conducted an impact assessment.
That's great.
Some people have said that they do have shareholder loans, clearly from the questions. And I think remuneration also, I think one person responded, yes, they have conducted benchmarking for remuneration.
Excellent.
But I think this is something that we know from our experience, that benchmarking just doesn't mean that it's a gut feeling, right? Benchmarking means actual documentation, justifying the remuneration that you're paying. And this could be whether, one thing is that there's usually an HR consultancy report that could really go and support what the remuneration you're paying. But there could be challenges because in this region, there are directors or executives that, are mainly, especially for family-owned businesses, that you know, are historically drawing a salary, but and they could be large and they could be beyond what the benchmark for the region is. So
Yes.
those are some of those risk areas that one needs to watch out for. With this, the audience, we have run out of time today. Thank you for joining us. Do remember to follow us on our socials, to follow us on LinkedIn, and to subscribe to our YouTube channel, for further videos, further webinars. Thank you all.
Thank you. Bye.